What's up, folks? This is the weekly news update for September 11th, 2023. We're going to be talking about what is happening with Airbnb laws, specifically in New York City, office buildings, what's going on there, and a little bit of other market shifts and some companies making some big acquisitions out there. Before we get going here, and this is part of the big knowledge nugget that I kind of wanted to start with first. Airbnb is done in New York, and the reason why I point it out, knowing that most of our investors don't invest in New York, although we have some holdings out there, it's important to note that like more these progressive types of locations like New York, California, Portland, Seattle, they'll push these more progressive laws, and it's something to see that's coming on in the future. You might be one of these people who went and tried to do long-term rentals, and then the prices went up, and to find good rental value ratios of 1% or greater is just really hard to find these days, which is why a lot of people are resorting to Airbnbs as part of their portfolio in terms of short-term rentals. However, huge danger there in case the recession comes or there's any softness in the economy, because what is short-term rentals? It's a discretionary spending item on people's budget, which is why we prefer to stay in the more workforce housing type of sector, because even in hard times, people need a place to live. But, here you're seeing New York kind of ban these types of arrangements. And now, maybe it has something to do with the hotel industry kind of lobbying for this. I know that's the case in Hawaii. Um, they're saying that for now on, all short-term rental hosts in New York must register with the city, and only those who live in the place they're renting and are present when somebody is staying can qualify. And the people can only have two guests. So it makes things really hard for outside people to invest in an area. And I've been kind of thinking of this and don't want to kind of take this a political angle, but like take a place like Hawaii, right? Like, with people, especially with all the stuff that's been happening in Lahaina, it's a real sad story that if you have all these outside investors coming in there and being able to rent their properties out on Airbnb, VRBO, then it really kind of takes that amount of money outside of the housing market for workforce uh, type of housing for your average lower middle class resident there to be able to stay there. But also the second multiplier is now that money leaves Hawaii, or in this case New York, and it goes to wherever the heck that landlord lives. And who knows where they could live, right? It could be out of the country. In Hawaii, you have a lot of out of the country buyers who will operate short-term rentals, and that money essentially leaves. So I think that's a little bit more impactful than taking a property out of the potential renting pool. Of course, that's sad and enough, but it's a big impact. And I'm all for like free will, free power, but I definitely don't like the way the direction is heading on these Airbnbs. That said, I stay out of it as an investor, right? I think that there is like an Airbnb short-term rental bus coming. And maybe when it does pop, maybe I'll buy a primary residence for myself. What the hey, right? But moving on, I think most of our investors are kind of understanding that, short-term rentals is a discretionary spending item, may not be what you want to base your entire rental property portfolio or your alternative investment portfolio. And that brings us into the second one. Well, what is? Well, maybe right now office is not one of those types of things, as remote work remains very popular and office buildings become increasingly empty. Now, definitely there's some, I used a harsh word there, empty. It's not quite empty, but places like San Francisco, where it's a predominantly tech type of employment, certainly more progressive in terms of work arrangements and remote working. You're going to have a lot more extreme examples of this take place. Goldman Sachs estimates vacant office space will jump by 267 million square feet over the next decade and beyond. Office leases will see a big ramp up in expiration starting in 2030. And I think this is with all that's been happening in the commercial real estate world. The commercial, real estate spans from multifamily, industrial, office. Multifamily and industrial seem to be, long term still going to be here in some respect. And I still think office will be here. Maybe it won't be 85%, 80% occupied. Maybe the new normal will be somewhere in this. But as times will change, they'll probably start to build a little bit less, and things will kind of rebalance over time. Here, Canyon Partners provides $174 million senior loan for recapitalization of Nashville office tower. So the reason why I bring this up, this is more of an institutional kind of play here. But what you're having is a situation where the current owners and the bank are kind of in trouble, right? So what they're doing is they're bringing in an outside investor to what I call recapitalization or recap. So they come in top of the older investors on top of the stack, and maybe they come in with that new fresh capital to change the loan, go from fixed floating rate to fixed debt, and that kind of right sizes the deal and gets cash flow positive. Certainly improves the loan to value as you get a bit of a refresh there. But this is a bit of a win-win in relationship because the 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 first investor that was in here, they don't have additional capital and they don't want to have a good asset go to foreclosure. And the bank doesn't want to go to foreclosure and doesn't want to run the asset. And this new uh, group that comes in to recapitalize the deal, they get a great asset where they know the problems and they get to put their money on top of the capital stack. And they also kind of engulf the remaining capital, if any, from the existing investors. So again, just want to kind of bring this to investors' attention. I was not aware of these types of investing strategies that, the big players do. But a lot of these types of situations are kind of workable on any type of size deals out there. Takes a little bit of creativity, definitely a lot of lawyers involved to get a lot of the paperwork done. But essentially, it's sort of like a mergers and acquisitions type of arrangement with not a lot of moving pieces, right? Because it's real estate, it's not an operational business, but just a different, more creative way of people structuring deals these days with the current situations that can. If you guys want to get more in-depth information into our deal flow and our club and get access to a lot of our free e-courses such as the syndication one, the infinite banking. I know a lot of people are stuffing money into infinite banking at this time, especially after they see what their tax bill is this next month because everybody's starting to file now. You guys can join up at simple.com/club. And of course, the new website, everything will seamlessly change over here in the next week or so, thewealthelevator.com/club. Moving on to the Bell Partners raised $1.3 billion for a value add multifamily fund. Now, I'm not going to say this for huge confidence quite yet, but it does seem like we are seeing some of the early players, the big institutional capital that has been sitting on the sidelines for well over a year now, start to come into the market. Now, I don't know what their trigger is. I don't know what they're looking at. Perhaps they're seeing that the final rate increase happening by Jerome Powell in the near future, and they're seeing these assets being unfairly adjusted downwards in terms of pricing, creating a unique buying opportunity now. But this is kind of some of the signs and that we're seeing that there is somewhat of a reversal of the market and potentially a bottom. Unfortunately, retail investors typically wait until all signs point to green, which will mean if you're one of those retail investors, you'll probably come into the market around 2026, 27, and it'll be too late. And I say that a little bit sarcastically because, that's just unfortunately how retail investors are, right? Compared to, more numbers-based investors, the institutional professional investors. But sometimes it's kind of best to kind of look over their shoulders and see what they're up to. Next thing here, just kind of talking a little bit about where is the average consumer's head at these days. An article here saying shoppers pulling back on those big ticket items as furniture appliance sales start to lag. And I see this on the surface, it looks like bad news, but I see this as really good news as finally these increases of interest rates have somehow found its way into the average consumer. Retailers are facing a challenge that shoppers are reluctant to make these big purchases. Why? Because they're starting to feel that pinch. Home Depot reported 5.5% year-over-year decrease in big ticket transactions above $1,000. And the furniture industry have faced closures and financial difficulties due to weak sales and financial challenges. So hopefully I see this as good news, right? Like we're kind of feeling the pain to some extent. And maybe this might be the sign for the Fed to, kind of ease off interest rates. And then who knows how long they hold it there. And then this should be the start of that reversal. But certainly the, US core S&P Case-Shiller index was even year over year in June, signaling a market shift too. So this is probably better for you guys to see on the YouTube channel, which kind of shows a nice little chart of how the Case-Shiller index peaked there in June 20 and through June of 2022 and came down. And then we're kind of getting the end here, but there is some acquisitions by some of the larger players here. Howard Hughes breaks ground on a 200-unit multifamily project in the Woodlands, a little bit more of an affluent area north of Houston, a place that we kind of really like. We try and stay out of that Harris County due to the recent tax increases down there in the city that you don't really see out in some of the outskirts. Like the Woodlands is kind of considered more of the suburb out there. But we'll be out there in Houston next month. So if you guys are part of the investor club by joining at simplepassivecashflow.com/club, make sure you book that onboarding call because we don't let you guys come out unless we've had a call and I know who you guys are out there because yeah, you never know these days. We don't we as strange as it sounds these days, with the internet being how it is, we don't really like to bring out random strangers to our events for meet and greets. We prefer, I think that's what's made our group very successful in the past is, there is that relationships with people who come and I think people have a great time because they realize that a lot of people are, somewhat vetted and it's just not just a bunch of random non-accredited investors off the street coming to some local real estate club or meetup. But if some of you guys know, I follow ITR Economics, great resource. They just released a nice little chart on their YouTube. I think you have to pay for their better reports, but on their free channel, definitely talking about reversing trends in terms of commodity prices and then regional trends with the housing market, pointing towards a recovery here in the near term, which signals a great time to get involved. If you guys want to pick up my old book, you guys can get it for free at simplepassivecashflow.com/book. But if you guys can help out, we're getting ready to launch the new book here in a couple of months. So shoot us an email if you guys would like to get on that advanced list. Maybe leave us a review. That would be very appreciated, as that's a great way to kind of, promoting the book, helping and using our community. If you guys can help me on that, shoot us an email at team@simplepassive.com. And we'll see you guys next week. Bye.